Today, we're talking about Palantir. The stock is down more than 70% from all-time highs, and a lot of people have been pushing this thing as a buy. I'm going to point out two big risk factors that I haven't heard anybody talking about, and then we're going to go into my price targets for the stock. All right, first, before we go any further, you've got to see my portfolio and my performance. I've got a $62,500 portfolio. We have put $72,500 in, and we're down almost $10,000. So before you listen to anything I say, just know that that's the performance of my portfolio since February 15th, 2022. This is a long-term portfolio. My goal is to add $3,000 a month and build it up to $1 million in 10 years. If you like that journey, that content, do me a favor and like the video and subscribe to the channel and stick around for the journey. Here it is on the day. We're down 3%, $2,200. These are the stocks that I own. I do not own Palantir. I don't have any short or long position in Palantir. And at this time, I don't intend to buy shares. But I'm always looking for the best growth companies. And so I'm giving it a fair evaluation because I'm considering it for my portfolio. So first, let's do a quick background on just briefly what the business does. They provide organizations with solutions to manage large, disparate data sets in an attempt to gain insight and drive operational outcomes. Founded in 2003, Palantir released its Gotham software platform in 2008 for the government. Then they expanded into various commercial markets with Foundry in 2016 with the intent of becoming the data operating system for companies and industries. So let's quickly jump into the company's most recent quarterly results from the first quarter of 2022. They had revenue growth of 31% year over year. Commercial revenue, that's that second revenue segment that they have, grew 54%, accelerating for the fifth quarter in a row. Customer account grew 40 in Q1 2022, or 86% year over year. This is risk number one for this business. They do not have a lot of customers. One thing I do like is that they are getting more efficient from a GAAP operating margin perspective. So it increased to minus 9%, so still negative compared to minus 14% in Q4 2021 and minus 33% in Q1 2021. So if you look, last year it was minus 33%. They have improved that all the way to minus 9%, so major improvement. Their adjusted operating margin was 26%. What's the difference between GAAP and adjusted operating margin? It is stock-based compensation. So the amount of shares that they issue to employees or executives to get them to join or stay at the company. So this is the allure or the attraction of Palantir, in my opinion, is that they are trying to build essentially the AWS of the future for data. So they say what AWS was in the last decade, Amazon Web Services, Foundry will be in the next. The US Space Force's Kobayashi Maru software factory built 13 operationally accepted applications on top of Foundry in months, while sunsetting $100 million plus programs. Airbus rolled out an internally developed supply chain network control tower built on top of Foundry to mitigate supply chain issues, which is working towards saving hundreds of millions of euros annually. They added 37 net new customers in the first quarter of 2021 for commercial. And so we can see the trailing 12 months, March 31, 2021, they had 60. Now they have 184. One argument is that they're so early, there's so much upside, and that's true. But I'm going to get into some risks in a minute. Their sales cycles can be extremely long. And so here's one of my concerns. The US government drove long-term growth with 30% growth from 2013 to 2021, a 30% compound annual growth rate. But we can see from Q1 2021 to Q1 2022, that revenue only grew 16%. That is most of their revenue with commercial catching up. But in this environment, where I think the government revenue is more stable, more predictable, it does take a long time for those contracts. With a long sales cycle like they have, it's not something like Snowflake or Cloudflare or other software providers, Datadog, where there are enterprise sales that have that long sales cycle, but there's also kind of a user self-serve where they can quickly get up and going. These are very long sales cycles. So for that commercial side of the business, that could be a real danger or even slower, much slower growth than anticipated if we hit an economic downturn, which we're either in or close to, or the fear is there. Total commercial revenue growth. Here's what I was just talking about. 133 million in Q1 2021. It grew 54% to 205 million, which is impressive, right? But here's a company, Snowflake, that I own in the portfolio that is trading at a higher multiple for sure. But we're looking at 85% year-over-year growth from Q1 2022 to their most recent quarter, Q1 2023, on roughly the same revenue, 422 million, 85% growth versus Palantir that was 31% year-over-year. That's my concern, is this business is about the same size in terms of revenue as Snowflake, at least for the quarter. But Snowflake is growing more than twice as fast, and they have a lot more customers, which leads me to the risk that I want to talk about. And so where do we find these risks that a lot of people don't talk about on YouTube? Annual reports. This is from their 10K. You can find these on the SEC website if you Google Palantir 10K. This is directly from their 10K. The company management wrote this, or their lawyers, and then management approved it. They have a risk factor summary. Our sales efforts involve considerable time and expense, and our sales cycle is often long and unpredictable. A limited number of customers account for a substantial portion of our revenue. Our platforms are complex and may have a lengthy implementation process. This is what I wanted to talk about. And so there's all kinds of risks laid out. You can look at Snowflake's 10K and they've got tons of risks, but not these risks, not the customer concentration risk, and not the long and lengthy sales cycle risk. So here's what they say. We expect that our costs of revenue and operating expenses will continue to increase. To the extent we are successful in increasing our customer base, we may also incur increased losses because the costs associated with acquiring and growing our customers via our acquire, expand, and scale business model and with research and development are generally incurred up front, while our revenue from customer contracts is generally recognized over the contract term. Okay, that part is normal. Furthermore, our sales model often requires us to spend months and invest significant resources working with customers on pilot deployments at no or low cost to them. That is the key, which may result in no or minimal future revenue. We may not be able to increase our revenue at a rate sufficient to offset increases in our costs of revenue and operating expenses in the near term or at all, which will prevent us from achieving and maintaining profitability in the future. We often also provide our platforms to potential customers at no or low cost initially for them for evaluation purposes through short-term pilot deployments of our platforms in the acquire phase of our business model. There is no guarantee that we will be able to move customers from the acquire phase into later phases. In addition, we have a growing direct sales force. This is another key point. I forgot to point it out. Alex Karp, the CEO, used to do a lot of the big sales himself. And we can see they have less than 200 or so customers. And so one person could get 100 customers over time, right? But if you start to talk about thousands of customers, that doesn't scale from one person. So they lay this out here. Growing a direct sales force and our sales efforts have historically depended on the significant involvement of our senior management team, aka Alex Karp, the CEO. The length of our sales cycle from initial demonstration of our platform to sale of our platform and services tends to be long and varies substantially from customer to customer. Often lasts 6 to 9 months, but can extend a year or more for some customers because decisions to purchase our platforms involve significant financial commitments. Potential customers generally evaluate our platforms at multiple levels within their organization, each of which often have specific requirements and typically involve senior management. Customer concentration risk. This is huge. Our top 3 customers together accounted for 18 and 25% of our revenue for the years that ended in December 2021 and 2020. So it is getting less concentrated, but 18% in 3 customers is a lot of concentration. Certain of our customers, including customers that represent a significant portion of our business, have in the past reduced their spend with us or terminated their agreements with us, which has reduced our anticipated future payments or revenue from these customers, and which has required us to refund some previously paid amounts to these customers. It is not possible for us to predict the future level of demand from our larger customers for our platforms and applications. And then last one on the implementation process. Our platforms and services are complex and are deployed in a wide variety of network environments. Implementing our platforms can be a complex and lengthy process since we often configure our existing platforms for a customer's unique environment. Inability to meet the unique needs of our customers may result in customer dissatisfaction and or damage to our reputation, which could materially harm our business. Further, the proper use of our platforms may require training of the customer in the initial or ongoing services of our technical personnel, as well as O&M services over the contract term. If training and or ongoing services require more of our expenditures than we originally estimated, our margins will be lower than projected. So a few things here. You could either A, really like this because it's hard for anybody to go out there and replicate what Palantir is doing. It's expensive. They don't want to work with those big government customers. They don't want the customer concentration that Palantir has. It's expensive to do it. It's very hands-on. Those could all be considered a competitive moat. But what we have to figure out is Palantir the best option for the money we have, or some of the money we have to invest in, when there's so many other stocks that have also sold off a lot and have just a much clearer path to a profitable future. Ultimately, what that comes down to is figuring out what we think the profitability is going to be, the revenue growth, and the business value is going to be in the future. Shared this tool yesterday. This is the Everything Money platform. Again, paying subscriber. These guys are not giving me anything. I pay full price for this and just signed up on my own. But we can look at different metrics. So I want to be quick here, so I'm just going to hit kind of the highlights. They had revenue of $1.65 billion over the last 12 months and net income trailing 12 months of negative $500 million. They had a negative 30% profit margin, and their gross profit margin is 78%. They did have $225 million in free cash flow over the last 12 months, and their return on equity is minus 22%. Okay, one thing to point out, they do have a pretty strong cash position, $2.3 billion. They have $285 million in long-term liabilities, so strong cash position and not a lot of long-term liabilities. Not really worried about the debt there. And then cash flow, so minus $353 million in net income in 2020, minus $1.2 billion into 2021, and then minus $498 million in 2022. So an improvement from 2021, but still less net income, more negative net income than 2020. Okay, and they have been issuing shares. So this was part of the IPO, but they had $1.8 billion in 2021 and now $2 billion in 2022. All right, and let's look at their stock analyzer tool. This is where we can take all of these feelings we have, these qualitative feelings, they're in a massive market. They have big government customers. They do important stuff. We can take all of that and try to put it into numbers and see what scenario, paint out a few scenarios to give us an idea of what prices we might be interested in buying the stock at. This is gonna be different for everybody. These are not, where I'm saying the stock is going. I'm just using this to think about where I might wanna buy this stock compared to other stocks. We wanna figure out over the next 10 years what to put in for low, medium, and high average assumptions for these different categories are. So for revenue growth. I'm not gonna make that up, right? What I can do is use kind of the analyst expectations that are out there, which are always wrong, but they give us a baseline to expect. We go to Seeking Alpha. You can also look this up on Google. We could see consensus revenue estimates for the next, really through 2031, but important to note, there's only one analyst after 2025, so how accurate can that be? Basically, they have them right around 28% to 29%, and then going down to 23 to 17 and even 12%. Let's just use that in our range, right? So again, we're thinking 10 years out, not 3 years out. So we'll go 23, 26, and 29. Profit margin, and this is the hardest one because we have no idea, and management really hasn't given any guidance on it. And this is where biases might creep in, right? We'll go 10, 13, and 16. For free cash flow margin, we'll go 13, 15, and 17. And then for PE, if analysts are kind of thinking, through the next couple years, 40% earnings growth, maybe they're growing EPS at, 20 to 25%. What PE are we willing to buy at? Biases creep in here, but 17 low, 19, and then 21. Price to free cash flow, 18, 20, and 22. Desired annual return, this is higher risk in my opinion. I'm gonna use 15%. I can get 8 to 10% in the S&P 500. If this is a higher risk company in my opinion, then normally something around 12, 13 is probably what I would want to do for an individual stock, but I'm gonna go up to 15 because I think this is a higher risk company. This is a general baseline, I think it's pretty fair for where I would be willing to buy shares based on these scenarios. In the low situation, if they end up doing 23% revenue growth on average over the next 10 years, profit margins 10%, free cash flow margins 13%, and granted, maybe that's low, right? The PE is 17 and the price free cash flow is 18. I would be willing to pay $389 today. Price is $9.55. In the mid scenario, 26% revenue growth, 13% profit margin, 15% free cash flow margin, 19 PE, and 20 price free cash flow. I'd be willing to pay, 678 multiple of earnings or 812 on a multiple of free cash flow. And then in these high scenarios, that's the only one where it's currently a buy. 29% revenue growth. We're talking 10 years out. That's a long time if they're growing revenue at 31% right now. 16% profit margin, 17% free cash flow, a PE of 21, and a price free cash flow of 22. Then you'd be willing to pay 11, 12, or 12.27 if it's discounted free cash flow. And so, you know what I'll do is I'll add it to my watch list. I'm going to go below 678. If it gets below 678, I want to take another look. And let's head over to the watch list. I'm going to tell you why Palantir is not a buy. Facebook, Meta, just did a video on it yesterday. I came to a conclusion using estimates, different estimates, right? But that I would be willing to essentially buy it under 246. It's currently at 164. So I have this target price of over to remind me, hey, if this thing gets over 246, I need to take a look and see if it's still worth buying or owning because it might be overvalued at that point. But when there's companies like that are just so much cheaper with very strong growth, very efficient growth, I would go towards something like Meta over Palantir at these prices and in this current scenario. That's just me, and it's only my opinion. You saw my performance. It's not good. Let me know in the comments what you think of this video. Give me a company you want me to review, and I will do listener or subscriber request reviews.